Financing gas station and convenience stores. And gas station and convenience stores remain one of the most resilient commercial real estate asset classes in America. While retail continues to evolve, well located convenience stores have become essential service businesses that benefit from fuel sales as well as food service, beverage sales, lottery revenue, car wash income, and other ancillary profit centers. For investors and business owners looking to acquire, refinance, expand, or develop a gas station or convenience store, understanding financing options is critical to maximizing returns and securing favorable loan terms. Fortunately, today's lending environment offers a variety of financing solutions ranging from conventional bank loans to SBA financing and all the way to private capital. So let's talk about why lenders like gas stations. Many lenders view gas stations and convenience stores as attractive commercial properties because they generate multiple income streams. And you've been to many gas stations, and revenue can come from, say, their fuel sales or their convenience store sales or food and beverage sales, like if they have a kitchen. But they also tend to have car washes and they sell lottery commissions or they sell lottery tickets. But they have ATM income, propane sales, they have truck and fueling, but also EV charging stations. And strong operators with proven financial performance often qualify for highly competitive financing options. So let's talk about the types of gas station financing that are available. And the first is conventional bank loans. And traditional banks remain one of the most common financing sources for established operators. And typical terms include, say, 20 to 30% down, with a 20 to 25-year amortization, with a 5, 7, or 10-year fixed rate. Competitive interest rates and personal guarantees are often required. Now, who would use those? These are for experienced operators, not your first property. Stabilized properties with strong cash flow businesses. And there's also SBA 7A loans. So SBA financing is one of the most attractive options available for owner-operators, especially new owner-operators. And benefits can include lower down payments and longer repayment terms. And it's also financing for real estate and the business value. You can include working capital and you can include equipment into the loan. So this is why it makes it ideal for first-time gas station buyers, but also for business acquisitions or owner-occupied convenience stores. There's also SBA 504 loans. Same product, same SBA, but different product. And SBA can, with an SBA 504, you can get up to 90% financing with low long-term fixed rates, and you can do real estate and equipment in the same loan. But these programs are both particularly attractive when purchasing, say, a branded station with strong operating history. So, commercial real estate loans. When the focus is primarily the real estate rather than the operating business, commercial mortgage financing may be appropriate. So, some typical uses include investment property purchases, or the refinance of existing debt, or buying a portfolio acquisition type deal, or if you're doing a sale leaseback transaction. But bridge loans are another opportunity. Bridge financing can be useful when you're acquiring a distressed gas station that's not performing well and you're going to reposition it. Those underperforming assets will do better. You may need to complete environmental remediation or renovate the interior of a convenience store or expand the food service operations. And bridge loans provide flexibility when traditional lenders are just not ready to finance the property because of their financials. So, some environmental considerations. Gas stations are considered special purpose properties by the SBA, but they also carry environmental risks that require additional due diligence. So, lenders typically are going to require a phase 1 environmental site assessment, call it a phase 1. What that does is reviews historical property usage and identifies potential environmental concerns. But if there's contamination, then your phase 2 environmental assessment would be required. And that's done when there's contamination that's been discovered. So remember, they have to inspect the tanks, and lenders will often review the underground storage tanks, abbreviated as UST, any leak detection systems, any compliance reports, any regulatory filings. Environmental quality can significantly impact financing options and loan terms. So let's talk about some key factors that lenders evaluate. And one is historical financial performance. And lenders typically review the fuel volume, the inside sales, the gross margins, net operating income, but also tax returns and profit and loss statements, and the location itself. And strong locations often feature higher traffic counts, a signalized intersection, a growing population center, limited nearby competition, but also operator experience. And experienced operators generally receive better loan terms than first-time buyers would. Brand affiliation is another category. So national brands often enhance financing opportunities. So think gas names that you know: Shell, Chevron, Exxon, Mobil, Valero, Phillips 66, or BP. And branded stations may benefit from stronger consumer recognition and fuel supply agreements. Is also another reason for somebody to pull off the road. So, common loan structures. Well, there's acquisition financing. And this is when you're actually going out to buy an existing gas station or a convenience store or a truck stop or a travel center. But there's refinance loans. Owners may need to refinance as well. This generally is to lower your monthly payments or to extract equity or maybe to fund renovations or consolidate debt. But there's construction financing as well. And these are really available for new station development and ground up convenience store development. Or if you need to do something with your fuel canopy as far as build that out or expand it. Or car wash additions. So how much down payment is required? Well, typical requirements include, here's the loan type and the down payment. So SBA 7A is 10 to 15%, SBA 504 is 10 to 20%, and bank financing is 20 to 30%, and bridge financing is 25 to 40%. And the exact requirements are going to really depend on the borrower experience, the property condition, the cash flow, the environmental findings, and the credit profile. So let's talk about why lender matching matters. And gas station financing is highly specialized, and not every lender will touch or finance a fuel station or a convenience store or a truck stop or a car wash or even a mixed use fuel type property when you have like some service work there or a body shop. But working with a commercial mortgage advisor who can access hundreds of lenders can dramatically improve your financing outcomes. And the CommLoan platform provides access to more than 700 lenders and thousands of commercial loan programs, helping borrowers quickly identify the most appropriate financing sources for their specialized property type. So, final thoughts for the day. Gas station and convenience stores continue to offer attractive opportunities both for investors and owner-operators alike. So whether you're acquiring an existing station or refinancing a mature asset or developing a new location, financing options exist for virtually every business plan. And success often comes down to preparation, environmental due diligence, operator experience, and matching the opportunity with the right lender. So if you're considering purchasing, refinancing, or developing a gas station or convenience store, exploring multiple financing options early can help secure the best rates, the best terms, and the best long-term outcome for you. And that, my friends, is it for the day. Thank you for watching. Please visit my website, billrapp.commloan.com. You can start a pricing quote and also schedule a consultation so we can have a conversation. I appreciate your time. Have a good day.